Namaste, welcome to Arthaniti. Today, let us focus on target maturity funds. Well, these are debt mutual funds. So, basically, for investors who have a low to medium risk appetite, these are the funds that you can think of as investment options. Right now, in a recent news report, I read that nearly 175 trillion rupees. Yes, 175 trillion rupees have been invested in bank fixed deposits. Well, this huge figure, which is invested in bank fixed deposits, only show the risk aversity of investors. It shows us that most of the investors put safety above the returns that they get on their investments. For all such people, a target maturity fund is also an equally viable investment option. Now, let us check how that is the case. Normally, when we make an FD, we make it for a fixed period of time, say 6 months, 1 year, 2 years, so on and so forth, right? We all know how the bank FDs, available options of keeping money in a fixed deposit in a bank are, correct? It is easily available in any bank with the FD rate card, right? Like fixed period, for which we know that on a say particular date our money in the fixed deposit will mature and be returned back to us. In a target maturity fund as well, the maturity of the fund is fixed, correct? Like an FD, the target maturity fund also has a fixed maturity date. In fixed deposits, the rate of return that we are going to earn on our money is already known. It is printed on our FD receipts. But in a mutual fund, as per the SEBI guidelines, a fixed rate of return cannot be printed or declared. It gives an indicative return. Correct? But with fixed maturity plans, what happens is the investment or the portfolio in which our money is invested in a target maturity plan also matures on the same day our plan matures, correct? So the portfolio and our scheme has similar maturity dates. The yield to maturity, which is published in all month end fact sheets, gives approximate returns that you can expect from your investments in a target maturity fund. Correct? Why am I saying this? Why? Because since normally in a bond market, what happens is the bond prices fluctuate on a daily basis. Now, at the time of maturity, if the bond market prices are high, then you get better returns, correct? But with target maturity funds, what happens is the underlying securities in which the fund has invested in are going to mature on the same day that your fund is going to mature, correct? So on the maturity date, the underlying securities will be redeemed at face value, correct? So there is no fluctuation in the market prices of the securities on the day of maturity. Plus the interest that you will earn on those underlying securities is published in the month end fact sheet. So what happens is, since the maturity periods are similar, the underlying securities and the scheme maturity, the yield to maturity, that is the interest that you will earn on those securities, is more or less the same, correct? So what happens is there is no prediction or the risk of lower returns is comparatively very less in case of target maturity funds. Now, what kind of securities does this fund invest in? See, basically, when the fund has a known maturity date, target maturity funds normally invest in Government of India securities, which are sovereign bonds. There is zero credit risk on those bonds, correct? Or state government bonds, which is again a GSEC security as per RBI classification, or AAA rated corporate bonds. So since they know that on a fixed date the money has to be returned back to the investor, the quality of the underlying assets, underlying securities in which these schemes invest in is very high. So the level of risk involved is also comparatively very negligible in case of target maturity funds. One question that would arise in your mind is, are target maturity funds, TMFs, and fixed maturity plans one and the same? Well, no. Even though the underlying principle that they get matured on a set date is the same, there is a difference between the two types of mutual funds. Well, a target maturity fund is an open-ended debt fund, right? Whereas a fixed maturity plan, if you remember, some days back I had posted a video on Bharat bond ETF. Well, that was an example of a fixed maturity plan. A fixed maturity plan is a close ended debt fund, correct? So this is the basic difference between a target maturity and a fixed maturity mutual fund. What is the basic difference between open-ended and close-ended mutual fund? Well, the difference is of liquidity. Open-ended mutual funds offer higher liquidity, whereas close-ended mutual funds have limited liquidity, where proceeds are only you get back the proceeds at the time of maturity or after a fixed lock-in period is over. One more difference that you should keep in mind between a target maturity fund and a fixed maturity fund is, target maturities are basically plain simple versions of a fixed deposit. Instead of investing a money in a bank, these funds invest money in high credit government securities. Correct? So these are plain vanilla debt funds. Since they are passively managed, the expense ratio in a target maturity fund is way lower than in a fixed maturity plan. So as compared to a fixed maturity plan, the expense ratios of target maturity funds are low. See, one thing that you should always keep in mind when investing money for a fixed period of time is, normally the underlying securities in which you are investing should match, the maturity of those securities should match your targeted maturity duration. Why am I saying this? Why? Because the volatility in that case matches with your redemption dates and is comparatively much lower in that case. Now, for all such investors who are investing for a known maturity period, you should always think of a target maturity fund as an option for investment. Why am I saying this? Because of the tax efficiency that debt funds give you. Correct? Now, in case of debt funds, if you hold your investments for more than 3 years, correct, long term capital gains tax is applicable, where you can get indexation benefit after the maturity of 3 years. So if you are looking for investment in a target maturity fund, look for an investment for at least 3 years to get indexation benefit, right? So today I wanted to make a video on this. Why? Because in the current market scenario, where the central bank, the Reserve Bank of India, is increasing the interest rates, where we are near the peak of the interest rate cycle, this is the time to invest in fixed interest earning securities or bond securities. Correct? So if you are looking for a lower risk investment, instead of putting your or parking your funds in a bank fixed deposit, which is going to give you no tax efficient returns, plus a return which is lower than the current inflation rate, you can always think of a target maturity plan for investing your money and still get better returns with tax efficiency. If you have any further questions on this type of mutual fund, please comment below the video. As usual, I will be happy to help you. See you for till the next video. Be safe. Bye.